Hi guys! Enjoy John's analysis.
Strategy. Michael Saylor's company just sold $216 million worth of Bitcoin. And here is the answer up front, before the charts, before the spreadsheet, before anything else. No, this is not the beginning of a panic. It is closer to the opposite. It is a company proving in public with real money that it can survive without being forced to dump its treasury. And the market's reaction to that sale is the single clearest piece of evidence you have that most people watching this story are reading it backwards. Here is what actually happened today. Bitcoin dipped to $61,000 and bounced back almost immediately. The trigger for that dip was this exact sale, $216 million in Bitcoin, sold by the largest corporate Bitcoin treasury on the planet. If that headline is the only thing you saw, it sounds alarming. Saylor's company selling Bitcoin. But the speed of the recovery tells a completely different story than the headline does, and by the end of this video, you are going to understand exactly why. This video is not going to defend strategy uncritically, and it is not going to pretend the company's messaging has stayed consistent through this cycle, because it has not. What it is going to do is walk through the actual mechanics of what was sold, why it was sold, how the market responded in real time, and what the broader on-chain and macro picture looks like underneath all of it, so that by the closing minutes of this video, you can answer the title's question for yourself using evidence rather than the gut reaction a scary headline is designed to produce. Let's slow down and actually walk through the mechanics here, because almost nobody reacting to this headline today understands what instrument is actually involved. Strategy's primary fundraising vehicle right now is STRC, a preferred stock structured to trade near a $100 par value. It pays a dividend twice a month, and that dividend is unusually high, somewhere in the neighborhood of 11 to 12% annually in dollar terms. Strategy's pitch to STRC holders is straightforward. We will pay you double-digit yield, and we will fund that yield by continuing to compound one of the best performing assets of the last decade underneath it. Bitcoin is up on the order of 3,000% since 2016. Against that kind of backdrop, paying 11% a year to hold a preferred share backed by an asset with that track record is, historically speaking, a trade that has worked out. STRC has not always traded near its intended par value. In mid-June, it went through what one analyst described as a leverage cascade, dropping from the low 90s to a fresh all-time low near $71 in under 2 weeks, roughly a 25% discount to par, before climbing back to the high 80s and now trading around $90 as trust in the structure rebuilds. That round trip, a real double-digit percentage collapse in confidence followed by a genuine recovery, is itself a data point worth sitting with for a second, because it tells you the market's confidence in this instrument has been anything but stable, and every move in STRC ripples directly into how people interpret Strategy's Bitcoin holdings. Strategy sits on more than 840,000 Bitcoin, out of a fixed total supply of 21 million. That is close to 4% of every Bitcoin that will ever exist, concentrated inside a single publicly traded company. A treasury that size is not a rounding error. It is one of the most closely watched balance sheets in the entire industry, and every transaction it makes gets treated as a signal about where the largest, most sophisticated Bitcoin holder on Earth thinks this cycle is headed. It is also worth being upfront about the part of this story that is genuinely uncomfortable for the company, because a fair audit of this situation has to include it. Strategy's average cost basis across its entire treasury sits at roughly $75,700 per coin, meaningfully above where Bitcoin is trading today. On paper, that means the company's Bitcoin holdings carry a real unrealized loss, reported in the neighborhood of $8 to $10 billion in recent quarterly disclosures, depending on the exact date measured. That is not a rounding error either, and it is the honest backdrop against which today's sale needs to be judged. A company selling part of its treasury to cover obligations while sitting on a multi-billion-dollar unrealized loss is a materially different, more pressured situation than a company doing the same thing from a position of pure paper profit, even if the mechanics of the sale itself look identical either way. It helps to understand why the company built this structure in the first place. Strategy is not simply holding Bitcoin passively and hoping the price goes up. It is running a leveraged capital markets operation on top of that holding, issuing instruments like STRC to raise cash at a fixed cost, in this case around 11 to 12% annually, and then deploying that cash into more Bitcoin on the thesis that the asset's long-run appreciation will comfortably outrun the cost of that capital over time. That structure works extremely well during a bull market, because rising Bitcoin prices push the value of the treasury up faster than the dividend obligations accumulate. And the company's own equity has historically been extremely sensitive to that dynamic, rallying nearly 3,000% during the prior bull market, as investors treated it as a leveraged, publicly tradable proxy for Bitcoin itself. The same structure becomes far more uncomfortable to operate during a drawdown, because the dividend obligations do not shrink just because the price of the underlying asset did, and Strategy's own stock has fallen more than 70% from its highs this cycle as a result. Selling a portion of the Treasury to cover those fixed obligations, rather than risking a missed payment or a distressed capital raise, is the release valve built into this design from the start. It was always going to be used eventually. The only real question was always going to be how the market reacted the first few times it happened. This is not the first time Strategy has sold, and it is worth being precise about that history. Today's $216 million transaction is actually the company's third disclosed Bitcoin sale since it began its accumulation strategy in 2022. There was a small tax-related transaction back in 2022, then a symbolic 32 Bitcoin sale in late May of this year, worth roughly $2.5 million, specifically to demonstrate that the company could meet its dividend obligations without depending entirely on new capital raises, and now this much larger sale. The market's reaction to that May test sale was outsized panic. Strategy's own stock dropped. Bitcoin's price fell hard in the surrounding weeks, part of the same broader slide that eventually took it from the low 70s down into the 60,000 range. A 32 Bitcoin sale, worth a rounding error relative to the company's total holdings, moved sentiment more than it had any statistical right to, purely because of what people assumed it meant. Before we go further, I want to hand you something right now, not at the end of the video. If headlines like this one, a Treasury company selling Bitcoin, are enough to make you second-guess your own position, you need a framework that does not depend on reacting to every single transaction that crosses your feed. That is exactly what the Bitcoin Holder's Bible is built to give you. The specific on-chain thresholds, the corporate treasury signals actually worth watching versus the ones that are just noise, and a 5-minute weekly protocol that tells you, using data instead of headlines, whether today's news changes anything about your position. Normal price is $97. Because you are here at the start of this video, use the code DIAMOND50 right now to bring it down to $47. The link is in the description and pinned in the comments below this video. Here's the part of this story that actually matters. And it is the part almost nobody covering today's headline is pausing to think through. After that first small 32 Bitcoin sale, Strategy had, in effect, already shown its hand. Yes, in a pinch, this company can and will sell part of its Bitcoin holdings to meet its dividend obligations to STRC holders, rather than default or dilute shareholders in a panic. That is not a secret anymore. It is now a known, demonstrated fact about how this company behaves under pressure. Today's $216 million sale is not new information about Strategy's willingness to sell. It is the same known behavior, executed at a larger scale, from a company that has already proven publicly that it has the capacity to keep meeting its obligations this way for a very long time, arguably for decades, given the size of its remaining treasury relative to what these sales actually cost it. Now look at how the market actually responded. Bitcoin dipped to 61,000 and recovered almost immediately. If the market genuinely believed this sale signaled that Strategy was quietly panicking, that the largest Bitcoin treasury on Earth was starting to lose faith in its own core thesis, you would expect a sale of this size to trigger a much deeper, much more sustained decline. Fear does not usually resolve itself within hours. Real capitulation, the kind that marks the start of a much bigger move down, tends to cascade, not bounce. Instead, what we got was a sharp, fast dip, followed by an equally fast recovery, which is a pattern far more consistent with buyers stepping in to absorb supply at a discount than it is with a market losing confidence in the underlying asset or the company selling it. Put simply, if large investors out there genuinely believed Strategy's selling meant something was structurally wrong, this correction would not have snapped back this quickly. The speed of the recovery is itself the evidence. It suggests the market is treating this sale exactly the way Strategy needs it to be treated, as routine treasury management from a company managing dividend obligations, not as a confession that the thesis is breaking down. So, to actually answer the question in the title directly, is Strategy quietly panicking? The behavior does not look like panic. Panic looks like scrambling, like surprise announcements, like a company changing its story under pressure. What today looks like is a company doing exactly what it told the market it might have to do months ago, at a moment it chose, in a size it controlled, using a mechanism it had already tested at a smaller scale first. That is closer to a company managing risk deliberately than one panicking under it. Let's step back from Strategy specifically and look at the broader picture, because the on-chain data around this exact price level tells a story that reinforces rather than contradicts what we just walked through. Start with the 200-week moving average. Bitcoin is currently trading below this level, and historically, dips below the specific long-term average have opened up a window that tends to appear only once every 4 years, generally at or very close to the actual floor of a Bitcoin bear market. This is not a metric that flags dozens of buying opportunities a year. It is a rare, structurally significant signal, and it is currently active. There's also a bullish divergence showing up on the weekly chart for the first time since the 2022 market bottom. Price recently registered a lower low, but the relative strength index, the momentum indicator that measures how much force is actually behind a move, printed a higher low over that same stretch. That combination, price falling further while momentum actually strengthens underneath it, is a classic signal that sellers are running out of force, even while the price itself still looks weak on the surface. Then there is the consolidation support built during an 8-month accumulation range that formed back in 2024. That range acts as a structural floor, and it is a meaningful part of why many analysts now expect it to be difficult for price to fall much below the $50,000 zone, even though a traditional Bitcoin bear market has historically wiped out 70 to 75% of the prior cycle's gains. This cycle looks different on that front specifically. The prior rally only took Bitcoin up roughly 600%, well below prior cycles, and the current drawdown has only taken back around 50%, also well below the historical 70+% norm. Smaller rallies up, smaller corrections down. That is exactly the kind of declining volatility you would expect from an asset that is maturing, and it shows up clearly in the Mayer multiple, a metric that compares price to its 200-day moving average. That reading currently sits at roughly 0.85, with Bitcoin near $63,000, meaningfully below the level of one that separates undervalued from overvalued, and well below its own historical average, even after this week's bounce. On the sentiment and positioning side, this drawdown has already produced multiple stretches of extreme fear. And while extreme fear readings have marked local bottoms before without guaranteeing anything, the current confluence of extreme fear alongside the other signals we are walking through strengthens the overall case rather than standing alone. We also saw forced selling from leverage play a large role in the sharpest part of this decline, with daily liquidations averaging north of $1 billion across 5 consecutive days in June. That is worth remembering if you trade with leverage yourself. You can be completely right about where this asset is headed and still get wiped out by a margin call if your timing on the way there is off. Long-term conviction and leverage trading are two very different games, and mixing them up is one of the most expensive mistakes people make in this market. Separately, the put-to-call ratio, which measures the balance of bets on Bitcoin falling versus rising, recently hit a one-year high, meaning bearish positioning has rarely been this crowded over the past 12 months. Historically, that kind of lopsided positioning toward the downside has coincided with major market bottoms, because it means the trade almost everyone is positioned for is a further decline, which is exactly the setup that tends to get squeezed the hardest when price does the opposite. Beyond the more familiar indicators, there are 3 specific Onchain and mathematical models worth walking through individually, because each one has an actual track record at prior bottoms, not just a plausible story. The first is a UTXO-based realized profit and loss ratio, a metric that tracks how much profit is currently locked into coins across the network relative to their cost basis. This model just flashed the same blue bottom signal it produced in 2015 and 2018 and during the March 2020 crash. Those are not arbitrary comparisons. In December of 2018, that signal coincided with Bitcoin near $3,000. In the March 2020 crash, it coincided with Bitcoin near $4,000. In each case, the signal fired at, or extremely close to, the actual bottom of that particular drawdown. And each of those moments turned out, with hindsight, to have been among the best entry points in the asset's history. The second is the long-term power law model, which plots Bitcoin's price against a logarithmic growth curve built from its entire trading history. Right now, price is not just touching the lower support band of that model, it is actually pushed slightly below it into a zone the model itself defines as deep value. That means, by this specific framework, Bitcoin is currently priced even more cheaply than the support line that has historically marked the floor of prior cycles. The third is the realized price under the MVRV framework, the aggregate average cost basis across every coin on the network. That realized price currently sits at approximately $53,500. In prior cycles, market value has fallen below this realized price line before a bottom was fully confirmed. This time, market value has not yet crossed below it, which is exactly why a note of caution matters here. It is entirely possible that price still spends time drifting in the $50,000 range before this cycle's bottom is fully in, and based on the pattern from the last 2 cycles, where roughly 12 months separated the top from the eventual bottom of the bear phase, that window could extend into October of this year. That timeline is a historical average, not a guarantee. It could resolve sooner. It could take a little longer. But it is a real possibility worth planning around rather than dismissing. None of these 3 models is infallible on its own, and each has produced false signals somewhere in Bitcoin's history if you go looking hard enough for the exception. What makes this moment different from a single indicator flashing green in isolation is that all three, a UTXO-based profit and loss model, a decade-spanning power law curve, and a realized price valuation floor built on entirely different methodologies and entirely different underlying data, are currently pointing toward the same general conclusion at the same time. That kind of convergence across independent frameworks has historically been a more reliable signal than any single model firing alone, precisely because it is much harder for three unrelated methods of measuring the same market to all be wrong for the same reason simultaneously. This is exactly the kind of moment where knowing which signals actually matter and which ones are just noise is worth real money. The Bitcoin Holders Bible walks you through each of the models we just covered: the UTXO profit-loss ratio, the power law band, and the MVRV realized price with the specific historical thresholds that separated genuine bottoms from false ones, plus the weekly 5-minute check that tells you where today's numbers actually sit against them. It is normally $97. Use code DIAMOND50 for $47. The link is in the description and pinned in the comments right now. There is a second audience this news matters to beyond general Bitcoin holders, and that is the people who actually own STRC itself, collecting that 11 to 12% dividend every 2 weeks. For that specific group, today's sale is arguably better news than it is for anyone else watching this story, and it is worth spelling out why. An STRC holder's primary risk was never really the price of Bitcoin on any given day. It was the risk that strategy might, at some point, fail to make a scheduled dividend payment, either because it ran short on cash or because it was unwilling to sell any Bitcoin to cover a temporary gap. Today's sale directly answers that question in the holder's favor. The company has now demonstrated twice, first with a small symbolic sale and now with a much larger one, that it is both willing and able to convert part of its treasury into cash, specifically to keep those payments flowing on schedule. If you are holding STRC for the yield, that is closer to reassurance than alarm. The instrument is doing exactly what it was designed to do. That is also, by the way, a big part of why STRC's own price has been climbing back from that mid-June low near $71 toward the $90 area it trades at today. A preferred share's price tends to track the market's confidence that the issuer can keep making payments, not the price of whatever asset backs it on any single day. The rebound in STRC's price is, in effect, the market voting with capital that this dividend obligation is safe. At almost the exact moment, the headline about the Bitcoin sale that funds it is generating fear elsewhere. That contradiction, fear in one market reading of the story and rising confidence in the instrument the story is actually about, is worth sitting with, because it is further evidence that the panic framing does not hold up once you look at how the people with the most direct financial exposure to this specific question are actually behaving with their money. Let's zoom out one more level, because the timing of Strategy's sale did not happen in a vacuum. It happened inside a specific, recurring seasonal pattern that is worth understanding on its own terms. In prior midterm election years, specifically 2018 and 2022, June has historically been the worst month of the cycle for Bitcoin, typically followed by a relief rally or recovery bounce in July. That is not a guarantee this year repeats the exact same script, but it is a real, checkable historical pattern, and June of this year followed that same shape. It was a rough month, and the bounce we are discussing in this video arrived right on schedule in early July. Layer capital flows on top of that. U.S. spot Bitcoin ETFs recorded a record outflow of roughly $4.5 billion in June, the kind of number that, read in isolation, looks like capitulation. But zoom out to the broader macro picture and more than $10 billion left gold and Bitcoin ETFs combined over that same window, with a meaningful share of that capital rotating, at least temporarily, into artificial intelligence and semiconductor-focused ETFs. That tells you this was not a Bitcoin-specific loss of confidence. It was a broader risk rotation event, capital chasing the hottest theme in the market that happened to hit Bitcoin and gold at the same time for reasons that had very little to do with either asset's actual fundamentals. On the pure liquidity side, the Federal Reserve expanded its balance sheet by roughly $31 billion through quantitative easing in this same window. That is a small move in absolute terms, but directionally it matters, because the long-run case for Bitcoin has never really been about any single month's price action. It is about what happens to the purchasing power of fiat currency over years and decades, set against an asset with a fixed, mathematically guaranteed supply cap. Every time global central banks expand their balance sheets faster than the economy actually grows, that is the exact backdrop that has historically rewarded holding a scarce asset rather than cash, and it is a backdrop that has not gone away during this entire drawdown. It is worth being precise about what the July effect actually is and is not, because it gets thrown around loosely. It is not a guarantee, and it is not a mechanical law of the market the way a halving schedule is. It is a documented seasonal tendency, observed specifically in years that share the same midterm election cycle structure, where a rough June has tended to be followed by a recovering July. 2 prior instances is a real pattern worth knowing about. It is not a large enough sample to bet a portfolio on blindly. The honest way to use a pattern like this is as one additional data point that leans in the same direction as the Onchain models we already walked through, not as a standalone reason to act. When multiple independent lines of evidence, on-chain valuation, positioning data, and seasonal history all point the same general direction, without any one of them being individually conclusive, that convergence is worth more attention than any single one of them would deserve on its own. Since the whole premise of this video is a company potentially panicking, let's actually define what real panic would look like. So you have a genuine benchmark instead of just a gut feeling the next time a headline like this hits your feed. Real panic from a Treasury company like STRC would look like an emergency capital raise, announced with no notice, a sudden change in dividend policy without warning, a large, unscheduled sale disclosed after the fact, rather than in routine filings, or public statements from leadership walking back the company's long-term thesis. None of that happened here. What happened here was a disclosed sale, of a size the market could digest within hours, following a smaller test sale that had already telegraphed this exact behavior weeks earlier from a company that has been explicit for years about using Bitcoin sales as one tool among several to meet its dividend obligations. What would genuinely be worth worrying about going forward is a sale meaningfully larger than this one, arriving without warning, alongside a drop in STRC's price back toward its June lows near $71, or public commentary from the company suggesting doubt about its own multi-decade thesis. Watch those 3 things. They are concrete, they are checkable in public filings and price data, and none of them are present today. That is the difference between a headline that sounds alarming and a situation that actually is. There's a simple way to keep yourself honest about this going forward, rather than relitigating your fear from scratch every time a new strategy transaction hits the news. Bookmark STRC's price alongside Strategy's total remaining Bitcoin holdings, both of which are publicly available, and check them the next time a sale headline appears. If STRC is still trading in a stable range near its intended value, and the company's remaining treasury is still measured in the hundreds of thousands of coins, you are almost certainly looking at the same routine, telegraphed mechanism we just walked through, not a new crisis. That 5-second check is worth far more than reacting to the dollar figure in a headline alone. This is not the first time the market has had to figure out, in real time, whether a large, well-known holder selling Bitcoin meant something structurally alarming or something far more mundane. It is worth looking at how a couple of those prior episodes actually played out, because the pattern is instructive. In 2024, the trustees overseeing the long-dormant Mt. Gox bankruptcy estate began distributing roughly 140,000 Bitcoin back to creditors who had been waiting since the exchange's 2014 collapse. For months, leading up to those distributions, this was treated as one of the single biggest overhangs on the entire market, a wall of forced selling from creditors who, the theory went, would dump their long-awaited coins the moment they received them. Prices dipped around the actual distribution dates, but the anticipated cascade of selling never really materialized at the scale the fear implied, and a meaningful share of those distributed coins appear to have simply been held rather than sold, based on on-chain tracking in the months that followed. The headline fear and the actual market impact were 2 different things, and the gap between them was significant. Go back further to 2022, and you get a genuinely different animal, the collapse of Three Arrows Capital and the broader unwind connected to the Terra Luna implosion. That involved real, forced, disorderly liquidation, funds and lenders selling, because they had no choice, not because they were managing a dividend obligation on a schedule they controlled. The market impact of that episode was severe and sustained, not a same-day bounce. That is what genuine forced capitulation from a major holder actually looks like when it happens. And it looked nothing like today's strategy sale, either in its mechanics or in the market's reaction to it. The lesson from both of these prior episodes is the same one this video keeps returning to. The size of a sale in dollar terms tells you almost nothing on its own. What matters is whether the seller had a choice in the timing, whether the sale was disclosed in advance or discovered after the fact, and how the market actually absorbed it in the hours and days that followed. By every one of those measures, today's strategy sale sits much closer to the Mt. Gox distribution story, a scary headline that the market mostly shrugged off, than it does to the Three Arrows story, a genuine structural shock that took months to fully work through the system. There is a reason a headline like Saylor's company sold $200 million in Bitcoin lands so much harder than the actual mechanics of the sale justify, and it comes down to a simple, well-documented pattern in how people process information about trusted figures during uncertain moments. Strategy and Michael Saylor have spent years positioning themselves as the most committed, most permanent holders in this entire market, the company that famously said it would never sell. That reputation was the entire point, It made every subsequent sale, no matter how small or well explained, land with outsized emotional weight because it directly contradicts the story that reputation was built on. The May test sale of 32 Bitcoin broke that narrative symbolically. Today's much larger sale confirms that the symbolic break was not a one-time exception. It is now an established part of how this company operates. That is a real meaningful shift in how you should think about Strategy's messaging going forward. It is not, on its own, evidence that the underlying investment thesis has failed. This is worth separating clearly in your own head. Your confidence in a specific company's marketing story and your confidence in the underlying asset that company holds are two different things. Strategy, softening its never-sell posture, is a legitimate reason to be more skeptical of Strategy's specific messaging going forward. It is not, by itself, new information about Bitcoin's own supply, demand, or long-term scarcity, which is the actual foundation of the investment case, with or without this particular company involved. Strategy is the largest and most famous example of this model, but it is not the only company running it, and that context matters for how you read today's headline. A whole category of publicly traded Treasury companies has emerged over the past few years, businesses whose primary strategy is accumulating Bitcoin, or in some cases, other assets, on their balance sheet and financing that accumulation through a mix of debt, preferred equity, and convertible notes. When Bitcoin's price rises steadily, this entire category tends to get rewarded because the market applies a premium to the stock on top of the value of the underlying holdings, on the assumption that the company will keep compounding its position. When Bitcoin corrects sharply, as it has this cycle, that premium tends to compress or disappear entirely, and some of the more thinly capitalized players in this category have come under real financial stress, in a few cases being forced into distressed sales far less orderly than what Strategy executed today. That distinction matters. Strategy telegraphed its test sale weeks in advance, executed today's larger sale through routine channels, and has a balance sheet large enough that even a sale several times the size of today's would still represent a small fraction of its total holdings. Smaller, more leveraged Treasury companies do not have that same cushion, and when one of them runs into trouble, it tends to look very different from what happened here. Forced, chaotic selling with far less warning, often disclosed only after the fact. Lumping Strategy's calculated, well-telegraphed sale in with the more genuinely distressed situations happening elsewhere in the same corporate category is a mistake, and it is exactly the kind of mistake a scary headline invites you to make if you do not look past it. Let's go one layer deeper on why the specific headline lands so much harder than the underlying mechanics justify, because it is not just about Strategy's marketing. It touches something more universal about how people process a trusted narrator changing their story. For years, the loudest, most repeated line associated with this company was a simple, absolute one: never sell. That phrase became shorthand for a certain kind of conviction in this market, the idea that the truest believers do not just hold through volatility, they treat selling as something close to a betrayal of the thesis itself. That framing was powerful marketing, and it worked, in no small part because absolute statements are memorable and reassuring in a way that nuanced, conditional ones are not. The problem with absolute statements is that they leave no room for the ordinary, mechanical realities of running a leveraged capital structure, like needing to occasionally raise cash to meet a dividend obligation. The first small test sale already broke the absolute version of that promise. Today's larger sale did not break anything new. It simply confirmed that the break was real and repeatable, not a one-time exception the company would spend years quietly living down. Here's the part worth sitting with. Your emotional reaction to that broken promise is a completely understandable response to a violated expectation. It is not, on its own, new information about Bitcoin's fixed supply, its adoption curve, or its long-term scarcity, which is the actual foundation the investment case rests on. Conflating disappointment in a company's marketing with a genuine change in the underlying asset's fundamentals is an easy trap to fall into precisely because the emotional charge of the first one bleeds so easily into how you evaluate the second. All of this analysis is only useful if it turns into something you can act on, so let's make it concrete. Given that on-chain models point to a $50,000 range remaining a live possibility before this cycle's bottom is fully confirmed, and given that history suggests that window could extend into October, waiting for a single perfect entry price is a strategy that has burned people before. At the end of 2022, with Bitcoin trading near $16,000, plenty of people were waiting for a drop into the four-figure range that never arrived. Some of them are still waiting. On the other hand, buying everything at once near $63,000 and watching it slide toward the low 40s would understandably sting and would tempt you to second-guess a decision that may still turn out fine over a longer horizon. That tension is exactly why staged, recurring purchases, commonly called dollar-cost averaging, tend to work better psychologically than trying to time a single perfect entry. Buying in smaller, regular increments across the current range, rather than committing everything at one moment, smooths out exactly this kind of regret in both directions. You're not betting your entire position on being right about the next 30 days. You're betting on the multi-year thesis distributed across enough entry points that no single week's price action can wreck your average. There is a practical version of this you can actually set up today. Decide in advance on a fixed dollar amount and a fixed cadence, weekly or monthly, that you are comfortable committing regardless of whether the headline that week is Strategy Selling Bitcoin, a weak jobs report, or a quiet news day. Write down before you start the price zones where you would consider increasing that amount. For instance, if price does spend meaningful time in the $50,000 range, the Onchain models flagged earlier, and the zones where you would consider tapering it. For instance, if price runs well ahead of the realized price and power law bands we discussed. The entire point of writing these numbers down now, while you are calm and thinking clearly, is that the decision has already been made before the next scary headline arrives. You're not negotiating with yourself in real time under pressure with a red number flashing on your screen. You are simply executing a plan you already trust. This is precisely the situation the Bitcoin Holders Bible is built for. A headline that sounds like panic, on-chain data that argues something closer to accumulation, and a genuinely uncertain window of time still ahead before the picture fully clears. Inside it, you get the complete breakdown of the models we covered today, the specific thresholds for the 200-week moving average, the Mayer multiple, and the MVRV realized price, plus a written worksheet for building your own staged buying plan instead of trying to time a single perfect entry. It is normally $97. Use code DIAMOND50 for $47, and the link is in the description and pinned in the comments below. So, is Michael Saylor's company quietly panicking? Based on everything we just walked through, the honest answer is no, not in the way that headline implies. This looks like a company executing a known, previously telegraphed strategy at a larger scale, into a market that absorbed the news within hours rather than cascading into deeper fear. That is not what panic from the inside usually looks like. It is what disciplined, if uncomfortable, Treasury management looks like from the outside, wrapped in a headline, engineered to sound far scarier than the mechanics underneath it actually are. None of that guarantees Bitcoin does not spend more time in the $50,000 range before this cycle's bottom is fully confirmed. The realized price model, the historical 12-month bear market pattern, and the broader macro rotation into other themes all argue that patience, not certainty, is still the right posture here. And watch the three things that would actually signal real trouble: a much larger unscheduled sale, STRC sliding back toward its old lows, or public doubt from leadership, not the size of any single transaction in isolation. And here is the broader habit worth taking away from this video, one that will outlast this specific headline. Every cycle produces a handful of moments exactly like this one, a large, well-known holder making a move that gets reported with maximum drama, stripped of the context that would let you judge it properly. The instinct to react to the headline alone is understandable. It is also, almost without exception, the more expensive instinct. The slower habit, the one that actually pays off over years rather than single afternoons, is asking the same three questions every time one of these stories breaks. Did the seller have a choice in the timing? Was the move disclosed in advance or discovered after the fact? And how did the market actually absorb it in the hours that followed? Run those three questions on today's strategy sale, and the panic framing falls apart. Keep running them on whatever the next scary headline turns out to be, and you will find yourself reacting far less often and far more accurately than almost everyone else watching the same news scroll past. Drop a comment below telling me whether you think this sale changes anything about your own view of strategy or of Bitcoin itself, and I will pin the most interesting takes. If this video helped you separate the headline from the actual mechanics, share it with the one person you know who saw this news today and immediately panicked. See you in the next one.